Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. May corn futures has been moving very nicely up from our March 4th timeline. And as evidenced here in our chart, you'll notice that the market came in, made a very nice low at volatility-based support, and has been tracing up since then and is now sitting right up against resistance. We have resistance at about 366.5. And what's particularly important right now about where we live is that we are right in the middle of volatility-based support and volatility-based resistance. When the market sits in a range like this, especially since we have this 90-degree 366.5 resistance near where price action is right now, we're looking at an opportunity that would lead us to take a potential trade with a straddle, meaning that the market could very well collapse from here or look to find near-term resistance at the next level above the market. In all likelihood, we believe the market will probably move up to sideways and then eventually move back down into the summer months. But we really like the way in which the price action has traveled thus far, and having been up about 8 to 9 trading days, it was only expected that we would see a bit of consolidation right now up against near-term resistance. You'll also notice here that the market came in and made a very nice low up against our geometric timeline box. And more importantly, you'll notice the natural trend line is where the market has been tracing up. So even if the market's able to break up out of this current consolidation zone near the 366.5 number that we spoke about just a moment ago, we also believe that we have near-term resistance at about 373.5, which would set us up for a lower double top against previous highs, at which point it would be expected that the market could very well head back down into the summer months as mentioned before. Some key levels that we'd like to bring to your attention, first of all, is the point of control, which currently sits at 396. One standard deviation below that point of control is 373.5, and one standard deviation above is 420. So as the market makes its migration through prices, it's going to be important to watch how the market responds at these particular levels. If we do see some follow through with regards to the price action to the downside near term support lives about 2 standard deviations below the point of control, which is currently at 356. And so if the market is able to break through 356, we would anticipate much lower prices from there. But the first touch of 356, if it gets there, is going to perhaps cause the market to move a bit sideways or consolidate. We can see much of the same here for the December corn contract. First, let's highlight a couple of our key levels. 385 3/4 is currently where the market sits right now, or very close thereof. And we are also overbought, which again lends itself for the market looking to have found some exhaustion and then looking to perhaps turn back down. Above the 385 3/4 number, we have 395 3/4, and that's going to be a very important number here. A couple of things are coming together. First, we have our previous highs near this point. Additionally, we have volatility-based resistance right at this area here with regards to the band region. And once and if the market's able to get there, it would be natural again to expect it to turn down. But before it could even get up there, we have really key resistance where we live right now. We are right in the middle of volatility-based support and resistance. And like the other contract, a potential straddle is a potential trade opportunity before us right now. Taking a view of our geometric box metric, we'll notice here that prices are very close to our point of control of 391, currently sitting at 385.5. You'll notice that as the market comes in, we have key resistance coming in, which is part of what may be holding the market down a bit. Just below that point of control, we have 378 and 3/4, which is where the market could very well come down and pause to. And a break from there would send us all the way down to 373 at a minimum. So in many regards, we are sitting at a very key juncture with regards to this corn contract. We can see this natural resistance point here, which is where the market is banging against currently. But like before, it is overbought. We've had a very nice run up from that March 4th timeline. And so it's only expected that the market would, at the very least, would pause and either trade sideways or give us a bit of a pullback here. The maize soybean contract has been trading very nicely up from the lows, but I want to show you here a little bit about what we were talking about with regards to the straddle opportunity. When a market comes in and is touching near volatility-based support and is in between volatility-based resistance, we saw previously that the market bounced off of that support and then sat in the middle of this band for a bit. Typically what we have found is that the market will either make a run up to the next level or come back down again. But part of why the straddle works well here is when the market is right in the middle of the zone, this is where the volatility very much shrinks and gives us an opportunity to sit or to participate in the market with it having a very good pricing for us with regards to the options contract. Once it breaks out of this zone, we'll see the volatility come back into the market, at which point the premium will increase. But at the very least, what we find ourselves with is an opportunity to participate in the increase in volatility with the premium increase and being able to get out of the other side of the contract that we're in with minimal or at minimal loss or even at break even. Let's fast forward then and look at where we live right now. Earlier in March 4th, we talked about a potential turn point here, and you notice the market really got some great energy and really moved up. We are now just touching off of our bands and starting to move back down, and we also have a natural resistance level here in the market. So here we're sitting at a potential pullback right up against volatility-based resistance, and for the market to pause here and perhaps maybe start making its way down. Our next key timeline that we're looking at is March 24th, so we could very well see a decline down into this date and the market then make a small bounce, maybe a lower high, and then declining back down into the summer months is probably some of what we're expecting here. Our geometric box is giving us some great insight. We'll notice first of all that we have some resistance right up against our natural angle. Also, we'll notice that the point of control sits at 882, which is very close to where the market is right now. Market's currently trading at 888, so the market bounced up through the point of control just a little bit and looks to be coming back down into the point of control. One standard deviation above that level is 902.5, and one standard deviation below is at 862. So these three levels are going to be very important with regards to how this current contract looks to trace. Fast forward to the November contract and we see a thing of beauty here. Market came in, touched our volatility-based support at our bands, moved straight up to the next band above, and we see now the market is now starting to trade back down. We have 280-degree level sitting at 893. First key level of potential support. We anticipate the market will probably come through that, but you'll also notice that in the past that same level that we're now calling support was past resistance. And so how the market responds around this area is going to be very important for us to watch. And we also have this natural trend line that has been tracing up from before. It's our anticipation that the market will probably come in and test this angle. And if it breaks through here, then we should go to new lows in conjunction with the market being overbought. A few small observations here with the same contract. First of all, you notice that the end of our geometric box really pinpointed for us this top inside of the market. Second, our work also gave us insight as to where the top may come in. You notice here that one standard deviation above the point of control was at 906, and the high for the market came in just at about 907 or so. And so now the market's making its way back down. We have the point of control sitting at 889. Market's currently at 898. And so about 10 points down from here would not be unreasonable for this market its price action. One last thing to note, current highs that we did see corresponded with previous highs, making for a lower double top. And that could actually make for some weakness in this market here, looking for it to actually trade back down. And also we are currently overbought with regards to this contract. We're starting to see a consistent theme here across the grain markets. Here we have the July wheat contract, which currently is just hit up a volatility-based resistance and is also sitting at a 180-degree resistance level of 487. Market came in after making a very aggressive run to the top side off of its lows, and now it's pausing in conjunction with being overbought. The market should then make a nice little pullback. It might sit near 468, 469 or so. And if it breaks through there, we would anticipate that it could very well break to new lows. So we'll continue to monitor and see what's going on with this contract and to note where the strength is for its particular move. Now, you'll also notice with regards to the stochastic, the break that we're looking at here is not really breaking straight down, but you see that it's looking like it may decide to go more sideways. And so the strength of the sell-off may not be with your typical stochastic sells. So what we might be looking at is a more shallow pullback or a sideways move that actually gives us another leg up. So it's going to be important to watch how the price action actually trades over the next couple of days for this July wheat contract. A few observations here for the July contract. The point of control sits at 497 3/4. One standard deviation below that is at 471.5. Current prices are at 480. So we would anticipate at the very least that prices will probably come down and test that 471.5 number, given the way that it's moving and the fact that we have also hit the end of our geometric timeline, pointing for a potential top or a reversal in the market's price action. As we look at wheat, the narrative really remains the same, but we have quite a bit of shorts, and when short covering or profit taking occurs, it's not unusual to see a very strong run up in these markets, and we'll continue to watch as it trades, but the reality is the technicals are giving us some very good indications with regards to its price action. We will close today's technical outlook with a look at the crude contract, and we're really excited about this one here. For weeks now, we've been suggesting that the market would perhaps make a turn near March 11th. We had marked this off for you over several of our weekly updates, and part of why we felt that is because of the cycle that we had been running showed us that the market had made a turn on December 21st, and the same cycle made a turn on November 16th. The next time it projected forward was on March 11th. The market actually rose straight up into that timeline, up against our natural angle, and has been turning down since. And so it's very nice to see the market come in with those forecasted resistance and support levels. That top came in just shy of our 180-degree time, or rather 180-degree resistance level of 39 3/4. And now the market is pulling back. And if the market then pulls back into our April 8th timeline, then we would anticipate that the market would move back up and have a minimum price objective of 43.60 or so. Now, it is also possible that the market can come in, and instead of actually dropping into that April 8th timeline, it could very well actually only move down right in between and then move up into this April 8th timeline and then look to turn back down. But in either case, we're very happy with the turn that has been occurring in conjunction with our projected timeline. So if you were a person who was long the crude oil contract, you would have known in advance that this is perhaps a good probability zone to at least start to tighten stops and to protect your gains as a pullback was likely to occur around this timeline. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.